All right, we're gonna start talking about something super scary, guys. Today, we're talking about loans and credit cards. Scary stuff. So, we are actually gonna be taking a look at loans and credit cards today, the idea of buy now and pay later. And believe it or not, America runs on credit. Shocker, I know. So, in order to get a credit card or to get a loan, banks or financial institutions look at something known as your credit worthiness or your credit score. And that's basically deciding two things. Are you able to pay the money back? And how likely are you to pay the money back? So they want to look at those two things, and they're going to look at, do you have a job? Do you have steady income? Do you have other debts? Have you paid your past debts back in the past on time? And do you have something known as collateral? And collateral is something that the bank can take away from you if you don't pay them back on time. Scary. So we're going to start looking at credit cards first. So they look at your credit history, and that's how well you've managed your bills in the past and how well you've paid them back. And then once they allow you to have a credit card and you can swipe. So once you're done with all that swiping, banks actually constantly report you to something known as the credit bureau. And that credit bureau keeps a running log of all of your credit and payments that you've made throughout your history, and they give you a score. This is known as your credit score. You want a pretty good credit score. The better your credit score, the lower your interest rates generally are, and the better your credit score, the more that they let you borrow, because they know that, hey, this person pays their stuff back on time. Now, if you decide that you want to get a monthly loan, like a car note, or you want to put something at layaway at the store, or you want to take out a personal loan to work on your house, or you want to take out a mortgage, because you pay these on a monthly basis, paying down something known as the principal. The principal is the amount that you borrow. These are known as installment plans. So you are making installments or payments every single month until that balance goes from here to zero. Keep in mind, if you miss payments, they can either charge you late fees, or ultimately they can take away your property or whatever it is that you held as collateral. So, for example, if I took a loan out on my Jeep Wrangler, Betty White. So I took out a loan on Jeep Wrangler Betty White, and I don't pay it on time, and I go into default, and they say if I don't pay, they'll take my car. They can take my car. Scary stuff. So, making wise credit decisions, and I know that we've talked about rational decision making. Well, guess what? It applies with credit and loans as well. So whenever you're looking at making wise credit decisions, you want to look at fixed versus variable expenses. So if you're wanting to make sure that you can afford a credit card or afford a loan, you have to look at what your fixed expenses are, what you pay every month without a doubt, like your rent or your mortgage, maybe your insurance, maybe your school payments, maybe you've got utilities you have to pay. Those are fixed, you pay them every month, versus your variable. Your variable are things that can change from time to time. These are things like the amount you spend on food, entertainment, clothing, etc. Maybe even things that come out of nowhere, like Ted's vet bill the other day that was $526. Ted. Anyway, so let's take a look at the cost of borrowing money. So now that you're borrowing money, you have to pay in order to borrow that. This is going to be known as the interest. Interest is the cost of credit, and it's generally expressed in an interest rate. So the rate that is quoted to you when you open up a credit card is known as your annual interest rate. So let's say that I open up a credit card and they say that they're going to charge me 16%. That means for my whole year, they're going to charge 16% of whatever it is that I spent if I don't pay the card back in full every month. So it's always good to pay your card back in full every month. Same thing with a loan though. If your loan says that they're going to charge you 16%, that's high for a car loan, That means that of the total value of the car, they're charging 16%. But wait, there's more. There's also two different types of interest rates. They can be fixed or variable. You always want to get a fixed rate if you are borrowing money, because that means it stays the same and it doesn't go up and down and all over. You don't want the variable rate because the variable can change at any time depending on the market. So you could go from a 5% to start with and now boom, you're at 15%. Not good. So there's the fixed interest rate which never changes and a variable rate that can go up at any time. And when you get a personal loan from a bank, the bank will usually charge you a fixed annual rate of simple interest. So there's simple interest, which means that you are charged interest only on the original amount that you borrow, again, known as the principal. And I'll show you in a little graph what the simple interest looks like. Or they can charge you something known as compound interest. And compound interest is super dangerous because compound interest is interest that they charge not only on the original amount that you borrowed, but also on any of that interest that may have accrued and been added into the original balance. So interest is charged not only on the original amount you borrow, but on the existing amount that you owe. And that is what gets scary. And I'll show you what that looks like right now. So long story short, you guys have to be super duper careful with that swiping and super duper careful when you decide to open up loans. Don't forget, we do need credit and we do need to establish credit, but you can do it in smart ways, just so you know. Till next time, guys.